So if I sum them to one thing, the Fed have not yet realized, and nor have most market participants, that real rates have to be negative forever. And that's the only way of getting rid of the debt. That is financial repression 101. And it's not just being driven by the Fed, the markets are doing that because of the rate of return. So if real rates are negative, which was the 1940s and 50s too, because they had massive debts after the war, the outcome is actually higher asset prices. And I know people can't stand that, but that's what it is.
Hello and welcome to Wealthy Value. In today's video, CEO of Real Vision and global macro investor Raoul updates about the impact of Fed's recent rate hikes on the global markets, its impact on the price of Bitcoin and Ethereum, and the crippling world economies. He also states why a global shortage of dollars is taking place and how the markets can recover from this catastrophe. Make sure to stick around till the end of this video, where Raoul reveals most recent allocations in his crypto portfolio. If you like the video, don't forget to give it a thumbs up, subscribe to the channel, and turn on the post notifications. Let's dive right into the video.
What I'm worried about is what is currently breaking. And, you know, people say what's going to break, what's going to break. My view is that in a massively indebted world, to put this in perspective, the US is some 300 and something percent of GDP in debt, as total debts to GDP. It is 100% of world GDP in debt. It's the most indebted any nation has ever been. And everybody borrows dollars. And we're in a system where they're trying to act like Paul Volcker, because basically the Fed is run by a bunch of baby boomers and they want to get a book out where they're on the front cover like Paul Volcker to be the heroes. But I think what they're doing is fighting the ghosts of the past. The ghost of the past, the 1970s, was wildly different. We've talked about this in Daily Briefing before. The demographic setup is different. Also, the debt is different. I mean, the US is like 100% of GDP in debt, total debts at that point. We're now at least another 150%, maybe 200% of GDP in debt on top. So with an aging demographic and high debt, it's very difficult to generate inflation. But the Fed are now convinced they need to be Paul Volcker, and they are going to go and raise rates further than the market can deal with. And we're seeing it. We're seeing it everywhere, that the market's going, we cannot deal with rates like this and the liquidity that's happened. So liquidity has been drawn out by quantitative tightening. What they've done with the banks and what bank reserves have to be held has kept money out of the market. There's basically no buyer of the bond market. So there's a few charts. I think Claire's going to try and share them. Bond market liquidity is basically as bad as it was in the peak of the pandemic, when the bond market froze and everyone was worried Citadel had gone under, whoever had gone under. That's how bad the bond market is now. It is completely decoupling from anything, and I'll come on to that in a sec. The next chart, another way of looking at it, is bond market volatility. Bond market volatility is higher than stock market volatility. This is not normal. And again, we're approaching the peak of the absolute crisis when the entire world shut down and we thought everybody was going to die, right? That's how bad the situation in the bond market is. What that's done is decoupled the bond market from the underlying inflation story. So this is not a fear of inflation, really, because the Fed are saying we're going to do anything to kill inflation. Well, what's happened is the break-evens rate has agreed with that and said, yes, inflation is not the enemy. And break-even inflation, I'm looking at the 5 years, is at 2.4%, which broke down today. And 1 year is at 1.95. So they're basically around 2%. So the market's saying forward-looking inflation is back to normal. That dislocation has spilled through to the currency market as well. We've already been noting, you know, dollar yen, right? That was a specific situation because there was yield curve control, so you're printing yen. Then the UK starts cutting taxes whilst raising rates, and what happens is the currency collapsed, and today the pound was down 3.5%. This is in the top 5 largest currencies in the world, and it's down and more volatile than the Nasdaq. This is extraordinary, but it's not just that. The Eurozone has got the same problems. South Korea, it's a mess. What we've got is a shortage of dollars, something I've talked a lot about, many guests have talked about. There is a global shortage of dollars. The Fed are taking dollars out of the system, and what's happening is the safety valve is the US dollar is skyrocketing. Now, what that also does is export massive amounts of deflation. If you look at the nations who are suffering the most, it's the world's biggest finished goods exporters: China, Japan, Germany, South Korea, Taiwan. They're all seeing massive currency declines. So this is finished goods. This is TVs and computers and chips and all of that stuff. So the US kind of likes it. It also geopolitically, they like it because they exert their power, which is the biggest power they've got is the US dollar. 87% of world trade is in US dollars, even though the US is 25% of GDP. But you're choking the entire system. If we look at the next chart of Asian currencies, this is the ADXY, less looked at than the DXY. It's a basket of Asian currencies. That is breaking a head and shoulders top of a terrifying magnitude. I don't know what this is telling us, but it's telling us that there is no dollar liquidity in all of Asia. And this is a problem. It's a structural problem, not just a cyclical one that's happening now. Yeah, I haven't changed. So I'm bonds. I've got 10s, 2s, 5s. I've got everything and euro dollars. And I am long crypto. So I've luckily added significantly pretty much at the low. So lower than here in ETH and Solana around here, and some other bits and pieces. And I own some technology stocks, which I bought down 75%. A whole basket, bunch of different ETFs, doing the whole exponential age from gaming to metaverse to AI to robotics to genetic sciences to EV, all of these mega big picture themes. So I just bought a very broad basket there, which is a long-term bet, which again, if it sells off any further, and it hasn't made new lows for a long time now, since June, I would add into that. Time horizon's longer. I was actually talking to somebody today about what would I do in the short-term time horizon. I actually don't know. It's pretty hard. I might sell some oil, but it's really volatile and scary. I'd probably sell some more currency for a bit, versus the dollar, because I think the dollar goes higher. But those are matters of 2-week trades. I would be really nervous to be in any way in most of these kind of trades for longer than 2 or 3 weeks, because I feel like we're getting very close to the tipping point if this continues. Negative real rates, which nobody likes, but that's how you get rid of the debt, leads to higher asset prices over time anyway, because it forces money. So there's a lot of people who think that the whole trend is reversed forever and rates are going to be higher. I don't believe that, but I understand the point of view. So I'm not saying they're idiots or anything. Everybody is trying to figure this out. It's been extraordinary times. I think this has just been a bullwhip from the pandemic, and things settle down. We go back to below trend growth and falling inflation. That's the most unpopular view in the world right now. Doesn't really matter, because that's a battle for 18 months time. The next 18 months are slowing economies and falling prices. And opportunity, because a pivot has to come. And the pivot doesn't have to be a massive cutting of rates of quantitative easing. It just needs stopping of the rate of change of liquidity tightening. Pivot looks like, to me, not tightening the balance sheet, so no QT. Rate of change goes to 0. So you've got a beach ball underwater, particularly with something like crypto or technology, which has adoption models. So over time, they always grow. I mean, things like AI, just relentless. They're not going to stop. EV, not going to stop. Space, not going to stop. All of this stuff. So the rate of change of liquidity is like a beach ball holding it underwater. So the moment you just take your hands off, it bounces straight through. Now, quantitative easing is the wind that will lift it out of the water further. So a change of, we're not going to tighten any further and we're not going to do any QT, is going to bring ridiculous relief to markets, because markets hate uncertainty.
So, what are your thoughts about Raoul's perspective on Fed's rate hikes and market structure? Tell us in the comments. Also, don't forget to like and subscribe. See you soon with the next video. Thank you so much for watching.